Every dollar you have ever earned has a hidden origin story. Not the job you worked, not the business that paid you, not even the government whose name appears on the currency. Modern money begins its life somewhere else, in a moment most people never witness, inside a system most people never question. It begins as debt. And once you understand that single fact, the modern economy stops looking confusing and starts looking deliberate. Most people grow up with a simple, intuitive story about how money works. Governments print it, banks store it, people spend it. It's a story that feels obvious, it's easy to remember, and for everyday life it seems good enough. You earn money, you save some of it, you spend the rest. But this story quietly breaks down the moment you ask deeper questions. If money were primarily created by printing, inflation would rise in smooth, predictable lines. If money were limited by physical cash, massive credit booms would be impossible. And if banks were merely vaults for other people's savings, financial crises would look very different than they do. Yet the modern economy does not behave that way. It expands rapidly, it contracts suddenly, and it often does both without any visible change in the amount of physical cash. That contradiction is the first clue that the story we are taught about money is incomplete. Because modern money is not an object, it is a system. Open your banking app and look at the number on the screen. That number is not cash sitting somewhere with your name on it. It is not a pile of bills waiting in a vault. It is a record. An digital entry inside a ledger maintained by the financial system. A promise that when you make a payment, the system will honor it. Modern money is defined less by what it looks like and more by how it is recorded. In fact, every dollar in the modern economy exists simultaneously in at least two places. On one balance sheet, it appears as an asset. On another balance sheet, it appears as a liability. This is not a metaphor. It is the core structure of modern accounting. Money does not float through the economy like physical objects moving from hand to hand. It moves through balance sheets as obligations, claims, and entries. To understand where money comes from, you have to look at where balance sheets expand. In a physical economy, money feels tangible. You can hold it, you can count it. But the modern economy runs primarily on ledgers, digital records that track who owes what to whom. When you deposit money in a bank, the bank records it as a liability. It owes you that amount. From your perspective, that same deposit is an asset. You believe you can spend it at any time. This dual nature is critical. Money is not just something you possess, it is something the system agrees to recognize. And because money is a record, it can be created, expanded, or removed without ever touching a printing press. That is where debt enters the picture. Let's slow this down and look at the precise moment money is born. A borrower applies for a loan. It might be a mortgage, a business loan, a personal line of credit. The bank evaluates the application, income, collateral, risk, regulatory limits. If the loan is approved, something subtle but enormously important happens. The bank does not search for someone else's savings. It does not move existing money from one account to another. Instead, it creates two entries at the same time. On one side of its balance sheet, the bank records an asset, the loan owed to the bank. On the other side, it records a liability, a deposit credited to the borrower's account. That deposit did not exist moments earlier. No one transferred it. No one saved it first. It came into existence because a loan agreement was signed. This is the core mechanism of modern money creation. Money is not created first and then lent. Money is created because lending occurs.
This idea feels strange to many people because it conflicts with everyday experience. In daily life, you cannot spend money you do not already have. You cannot create dollars simply by writing numbers on a page. But banks operate under a different set of rules. They are allowed to create deposits because those deposits are matched by obligations. Every new dollar comes paired with a corresponding debt. The system functions not because money exists as a thing, but because obligations are recorded, tracked, and enforced. This is why modern money behaves differently from physical cash. It is elastic. It expands and contracts based on credit conditions. And this elasticity is not an accident. It is the design. For a long time, people were taught that banks simply take deposits from savers and lend them to borrowers. That description no longer reflects reality. Modern banks are not passive intermediaries. They are active money creators operating within a regulated framework. They are constrained by capital requirements, liquidity rules, and oversight. But within those constraints, lending expands the money supply. This is why credit can grow even when savings stagnate, why housing prices can rise faster than wages, and why financial expansion can occur without an equivalent increase in physical production. The limiting factor is not cash. It is confidence, regulation, and perceived risk. Here is the part that completes the picture. If money is created when loans are issued, then something else must happen when loans are repaid. When a borrower pays back the principal on a loan, the deposit used for that payment is removed from the system. The money does not go somewhere else. It does not circulate again. It disappears. Repayment destroys money. This means the money supply is constantly changing, not because of printing, but because of borrowing and repayment happening every day across the economy. Creation and destruction are built into the same mechanism. Now consider the implication. If repayment destroys money, and if debt is being repaid continuously, then new borrowing is required simply to keep the money supply stable, not to grow, just to prevent contraction. This is where the architecture of debt becomes impossible to ignore. Modern economies are not just tolerant of borrowing, they are structurally dependent on it. When credit flows smoothly, the system feels stable. When credit tightens, the system feels fragile.
This dependency is not the result of individual behavior. It is a feature of the design. And understanding that design is the key to understanding everything that follows. Once money is understood as a balance sheet phenomenon, inflation, financial cycles, and economic instability stop looking mysterious. They start looking structural. In the modern monetary system, money does not disappear because people suddenly decide to save more. It disappears when borrowing slows. This is a critical distinction. Debt is repaid every day, quietly, mechanically, without headlines. Mortgages are amortized. Business loans are serviced. Credit balances are reduced. Each of those payments removes money from circulation. Under normal conditions, this destruction is offset by new lending. New loans create new deposits. The system stays balanced. But when confidence weakens, lending slows first. Repayment does not. This asymmetry is the source of instability. The system does not collapse because something breaks. It tightens because something stops expanding.
A debt-based monetary system cannot remain static. It must either expand or contract. There is no neutral state. If borrowing merely matches repayment, the economy stalls. If borrowing falls behind repayment, the money supply shrinks. And if borrowing exceeds repayment, the system grows. This is why modern economies are structurally biased toward expansion. Growth is not just encouraged, it is required to maintain equilibrium. This requirement shapes behavior at every level, from households refinancing mortgages to businesses rolling over debt to financial institutions managing balance sheets. None of this requires bad intent. It follows directly from the architecture. Central banks exist because this architecture is inherently sensitive. They do not sit outside the system, they operate inside it. Their role is often misunderstood. Central banks do not create most money directly. They influence conditions, not outcomes. By adjusting interest rates, reserve access, and liquidity facilities, they shape how attractive borrowing becomes and how willing banks are to lend. Lower borrowing costs encourage credit expansion. Higher costs restrain it. This does not mean central banks control the economy. It means they manage the boundaries within which it operates. They are not the engine, they are the stabilizers. When people hear that central banks print money, they often imagine a direct flood of new currency into the economy. This image is misleading. What central banks primarily do is interact with financial institutions, adjusting balance sheets, managing liquidity, and influencing incentives. The money that most people use day to day is still created through lending. This distinction matters because it explains why monetary policy can feel disconnected from everyday experience. Money is not injected evenly, it enters through specific channels, and those channels shape outcomes. In a system where money is created through debt, price behavior becomes uneven. Assets that are easily financed respond first. Real estate, financial instruments, large-scale investments. Wages respond more slowly, not because of manipulation, but because wages are not created through balance sheet expansion.
They are paid from existing cash flows. This structural difference explains why asset prices can rise rapidly while household incomes lag behind. It is not a mystery, it is a consequence of design. Because lending creates money, decisions about risk shape the money supply itself. When lenders feel confident, money expands. When they become cautious, money contracts. Risk perception becomes a macroeconomic force. This is why financial cycles are often driven by sentiment as much as data. The system amplifies confidence on the way up and caution on the way down. This amplification is not emotional, it is mechanical. From the outside, financial disruptions often appear abrupt. Markets seize, liquidity dries up, confidence evaporates. But inside the system, the mechanics are gradual. Lending slows, refinancing becomes harder, repayment continues. The imbalance grows quietly until it becomes visible. What feels sudden is often the final stage of a long process. Debt is often discussed in moral terms. Too much debt, too little debt, good borrowers, bad borrowers. But at the system level, debt is neither good nor bad. It is structural. It determines how money enters the economy, how it circulates, and how it exits. Understanding debt as architecture, not behavior, changes the conversation. It shifts the focus from blame to structure.
A system built on debt can be remarkably productive. It allows investment to move forward in time. It connects future income to present action. It enables large-scale coordination. But it also concentrates sensitivity. Small changes in credit conditions can produce large changes in outcomes. Stability is not the absence of movement, it is the management of motion. Most people interact with money constantly without ever seeing its architecture. They see prices, not balance sheets, payments, not obligations, accounts, not creation. This invisibility is not accidental. The system works precisely because most participants do not need to understand it. But for those who do, patterns become easier to recognize. Once money is understood as a balance sheet phenomenon, many familiar debates look different. Inflation becomes a question of structure, not morality. Financial cycles become mechanical, not mysterious. Stability becomes conditional, not guaranteed. This perspective does not tell you what to believe. It tells you how the system functions. Modern monetary system is not powered by paper. It is powered by ledgers, by contracts, by obligations recorded, adjusted, and enforced over time. Debt is not a side effect of this system. It is the foundation. Once that foundation is visible, the behavior of the economy becomes easier to interpret, not simpler, but clearer. This is monetary index, and this was the architecture beneath the money.